If you're retired or heading into retirement, this is one update you don't want to miss. A new federal tax law has officially been signed, and it opens a limited window, just 4 years, that could significantly reduce the taxes you owe in retirement. Whether you depend on Social Security, have savings in a traditional IRA, or are living off investment income, these changes can reshape your entire retirement strategy, but you must act between 2025 and 2028 or the opportunity will disappear. This video will walk you through what the law changes, who qualifies for the new senior deduction, and why this may be the perfect time to revisit how you generate income during retirement. Before we begin, if you're new here, please like this video and subscribe to Social Security Post. We break down every Social Security and tax update in plain language to help protect your future. Let's begin by focusing on the timeline. The new law includes several important updates that will begin in 2025. But not all of them are here to stay. Some, such as the senior bonus deduction and changes to state and local tax limits, are only available for 4 years. That means retirees and older adults have from 2025 through 2028 to make changes that could lower their taxes for life. This limited window creates a strong incentive to take action now and avoid missing out. Many financial decisions, like converting a traditional IRA to a Roth IRA or realizing long-term capital gains, are extremely sensitive to tax rates. During this window, those rates may be more favorable than we've seen in decades. Delaying action until after 2028 could cost you in the form of higher taxes or missed deductions. These 4 years represent a rare chance to make bold yet smart moves with your money, so don't let them pass without a solid plan. For years, there was uncertainty around the 2017 tax cuts. Many assumed they would expire in 2025, leading to an automatic rise in federal tax rates. The 12% bracket would have jumped to 15%, the 22% to 25%, and the 24% to 28%. That would have meant higher taxes for middle-income retirees, especially those drawing money from pre-tax accounts like 401ks and IRAs. Thankfully, the new law locks in those lower tax brackets permanently. This clarity gives retirees more stability and room to plan effectively. Instead of bracing for higher taxes, you can now look at long-term strategies with a sense of predictability. Lower rates combined with enhanced deductions make it easier to manage distributions, do Roth conversions, and harvest investment gains without spiking your tax bill. In short, these permanent tax brackets offer relief and an open road to plan smarter. While the spotlight often goes to flashy credits or deductions, one of the most powerful changes in the new law is the increase in the standard deduction. Starting in 2025, this deduction rises by $1,500 for married couples and $750 for individuals. That brings the new standard deduction to $31,500 for couples and $15,750 for singles. This increase might seem small at first glance, but it has a huge effect because the standard deduction reduces your taxable income directly. A higher amount means less of your retirement income is exposed to taxes. Most retirees already use the standard deduction instead of itemizing, so this increase helps almost everyone. And remember, it's automatic. There's no form to fill out or hoops to jump through. This is a silent but powerful tool to lower your taxes. To fully understand the benefits of these tax law changes, let's walk through how your taxable income is actually calculated. First, add up all sources of income: Social Security, pension, IRA withdrawals, part-time wages, investment income, everything. From that total, subtract any above-the-line deductions you qualify for, such as contributions to a traditional IRA or HSA. This gives you your adjusted gross income, or AGI. Next, subtract either your standard deduction or itemized deductions, whichever is higher. The result is your taxable income. This is the number the IRS uses to determine how much federal tax you owe. The higher your deduction, the lower this number becomes. And that's what makes the 2025 update so meaningful. By boosting the standard deduction and adding the new senior bonus deduction, your taxable income could drop by tens of thousands of dollars, shielding more of your retirement money from taxation. One of the biggest wins for retirees in this new law is the senior bonus deduction. Starting in 2025, if you are 65 or older, you will qualify for an extra deduction of $6,000. If you and your spouse both qualify, you can deduct a total of $12,000 on top of the standard deduction. This deduction applies automatically, even if you don't itemize. What's truly remarkable is how this stacks up. In 2025, a married couple filing jointly and both over 65 could qualify for a total of $46,700 in tax deductions. That's almost half of their income, completely protected from federal tax. This could mean thousands of dollars in savings each year. And because this deduction doesn't require any extra paperwork, it's accessible to nearly every senior. A simple way to lower your tax bill while keeping retirement income strong. As generous as the senior bonus deduction is, there's an important rule to understand: income limits. If your income is too high, the deduction starts to phase out. For single filers, the phase out begins at $75,000. For married couples, begins at $150,000. If your income is far above those levels, the bonus deduction may be reduced or even eliminated. This makes income planning essential. If you're close to those thresholds, you may want to look at how to manage your income during the 4-year window. That could include spreading out IRA withdrawals, delaying Social Security, or reducing capital gains. Even small changes could keep you under the limit and allow you to claim the full senior bonus deduction. The key is awareness. Don't let an unexpected bump in income knock you out of eligibility for one of the most valuable deductions available to seniors. This 4-year window is your opportunity to take bold, smart action. One of the most powerful strategies during this period is converting traditional IRA funds to a Roth IRA. With larger deductions available, you may be able to convert thousands of dollars into a Roth account and owe little or no federal tax on the conversion. That means future growth becomes tax-free for life. Another strategy is harvesting long-term capital gains. With your deductions higher, you can sell appreciated assets like stocks or mutual funds and potentially avoid any capital gains taxes. You might also want to adjust how you withdraw money from pre-tax accounts, leveling out your income so that you avoid big spikes later on when required minimum distributions begin. Whatever your financial situation, the message is the same. This is your window from 2025 through 2028. You can rewrite your tax future, but only if you act. To sum it all up, retirees are getting a rare break from the IRS. But that break has an expiration date. From 2025 through 2028, you have a unique chance to take advantage of lower tax brackets, bigger standard deductions, and the powerful new senior bonus deduction. The difference this could make over the next few years isn't small. It could mean saving tens of thousands of dollars, but these benefits don't happen automatically. You need a plan, whether it's reviewing your income strategy, converting to Roth accounts, or just making sure you don't cross income thresholds. This is the moment to act. If you found this helpful, please take a moment to like this video and subscribe to Social Security Post. We'll be here every step of the way, bringing you trusted, senior-friendly updates on the programs and policies that affect your retirement.